Howdy there, folks. Welcome into today's video. It's a buy one, get one free here today in this one, folks. First video for me to react to. Stock market still has material downside despite the recent rally, says Cantor's Eric Johnston. I'm going to listen to what he has to say, kind of share my perspective on that. That video is from about 4 hours ago. Then I want to react to this one from an hour ago. The Fed might cut rates this year if the U.S. gets weak employment data, says Joe Lefebvre. I guess that's how you pronounce it. You can tell me how to pronounce it, okay? Because somebody help me out there. So going to react to that one in this one and kind of share my perspective as well, because a lot of people are thinking like the Fed, there's no way they're going to cut this year. There's no way they're going to cut, and I think it's an important subject. So hope you guys enjoyed today's video. As always, I appreciate you being subscribed. New all-time high subscribers in the history of the channel, and pretty much we set a new record every day. So I appreciate everybody that enjoys the channel. Thanks for being here, folks. Also, just so you know, pin comment down there to get access to the $10 Patreon tier when we open that up on July 4th. It's going to open on July 4th, and then we'll close it back down after. But yeah, if you want access to that, we can send you it via email or text on the day. Let's get into this.
This platform repeatedly to make your case that the market was in a bad place, that stocks were going to go down sharply. You repeatedly came here and said your conviction was very high, and it hasn't materialized. In fact, we're up more than 20% off of the low. Why are you still bearish?
So to be fair, we resumed our bearish view at 39.50. We've been wrong. Our market's moved up about 10% since then. That's obviously in the context of being bullish from June of 20 for 50% rally in the market. We called the exact top in January of 22.
Market sold off 25%. Let's talk about the here and now. And then we called the bottom at 3,600. These are tactical calls that made repeatedly.
Yes. And so this one, we have been wrong so far. I firmly believe that this market still has material downside to it, and that owning equities is a very poor risk reward right now.
Why?
So let's talk about a few different things. So number one is the market's trading at 19.5 times earnings. So if you look back the last 50, 60 years, the multiple's been higher twice. It was during the two bubbles of the internet bubble and the COVID bubble. Now, are we ripe to go into another bubble? It's possible. I don't think we are, based on where inflation is, where rates are, and where we are in the economy, okay? The second point is where we are in the economy. We're at full employment. Prior bull markets have been declining employment, where you start a bull market in 2010, the unemployment rate's 10%. You can then add jobs to the economy and grow the economy. Same thing happened in the late 90s, right? You were adding jobs. You have not seen bull markets start with full employment. In fact, we've been below 4% unemployment rate 4 times in the last 75 years. Each of those ended in a recession. Why? Because you ultimately need a cleansing in the economy to then start the next cycle.
As I said to Jock,
if you're talking about a 10-year cycle bull market, that makes a lot of sense in regards to that, right? But I think one factor maybe he's not considering in this, right, is there's a famous saying, the stock market's not the economy is not the stock market, right? There's a scenario where if company, at the end of the day, let's be honest, okay, 50 to 100 of the most important companies in the world, they drive the stock market up or down, depending upon how those companies' earnings are doing. If those companies' earnings, if they're running their businesses really efficient, they got really good margins, the stock market's going up. That's just a bottom line with that. The stock market's going to go up in that sort of scenario. And so if company earnings continue to strengthen, you could have a market go up for several years. So I think that's just, you don't always need to have a devastated economy in order to have, and then come out of that devastated economy in order to have some sort of bull market. There's many ways you can get there, but it really always comes down to company earnings. The reason the stock market went up from, so much from obviously the 09 bottom through the next 10 plus years was, guess why? Company earnings went up substantially during that time. I can tell you, if company earnings went up obviously over that time, we wouldn't have obviously seen that sort of bull market.
Maybe the cleansing happened in the most bloated areas of the economy, the tech economy, okay? Mm-hmm. That's number one. And maybe the labor market is just different on the backside of the pandemic in ways that you, others who have been negative, and even, dare I say, the Fed itself have been.
And keep in mind, this is so big. This is so big. I just thought about this, okay? I feel like I might have made this point one time a long while back, but this could be just as impactful if you're talking about setting up the market for a multi-year bull run. Because in the great financial crisis, The big problem was not like inflation or deflation, even though we actually went through a period of deflation during the great financial crisis. The problem was company earnings obviously fell off a cliff because unemployment was going up. Well, have we had unemployment go up a bunch recently? Absolutely not. But you know what we have had that honestly has probably hurt people just as bad? We had something that we didn't deal with in the great financial crisis that can be just as devastating. And when you come out of that situation, it is like the sun comes out again. And that is massive inflation. It's not something we had to deal with in the financial crisis. We had an unemployment problem. This recent time, we haven't had an employment problem. We've had an epic inflation problem. The worst we've seen, obviously, in 50 years. And so that is becoming less and less of an issue. It's going to become basically a non-issue moving forward now at this point in time. So that breathes kind of a breath of fresh air out there. Consumer confidence starts to improve. If consumer confidence starts to improve, guess what? The economy can start to improve. If consumers aren't confident, they're not going to spend on a lot of stuff, right? That's just the bottom line with that. And then you can at least approach a possibility of lowering interest rates if you feel you need to lower interest rates, right? And that's a great feeling. So, and obviously we'll get into that kind of in the second clip a little bit in regards to that. So that's a very important factor that can't just be glossed over. We just went through a 50-year type historic inflation rate that is now ending. That seems like a little bit of the sun comes out and shines a little bit.
To understand.
So I think that's a good point. It's possible, right, that we could just stay at full employment for a much longer period of time than I think and that others think. But I think if that happens, we are going to have subpar economic growth. And the reason is simple, right? Ultimately, economy is to grow or decline based on jobs. You add jobs, the economy grows. So I think that is possible, that we could stay at this 3 point.
Real wages have been in such a bad place for quite some time now. If real wages start to tick up in a meaningful way over this next couple of years, that's something that would be very, very bullish for the overall economy, which would also be bullish for overall company earnings. Real wages, like if people are getting more and more poor, it's not a good thing. And that's just been the reality because wages haven't been able to keep up with the rate of inflation. If now we can flip that, and let's say the wage increases are a little bit higher, doesn't have to be dramatic, but a little bit higher than whatever everything else is going up in price, that's a very, very positive thing, and that could play out over several years.
% rate for a while, but I think in that scenario, growth is going to be very subdued, and it is not going to warrant then a 19 multiple when you can have a money market fund at 5.25%, right? Because rates will stay where they are, right? Long end rates probably go higher in that scenario.
Not if inflation continues to decelerate and come down. I mean, obviously the Fed is eventually going to move rates lower. They're not going to just keep the terminal rate at 5.25 or 5.5 or wherever they go to for forever.
I mean, there's an argument to be made that, and I would argue that if the S&P is at 4,400 and the unemployment rate's at 3.7%, inflation's not going to come down to a reasonable level that will be palatable to the Fed. Now, it might take 6 months.
Sir, that's just not dealing with facts. That's just not dealing with facts. Like, your opinion is irrelevant because what do we know factually? Factually, we know inflation rate is coming down in an epic way on a year-over-year basis, right? We're likely right now either in the 3s or the 2s. So we're getting pretty darn close now at this point in time. And we're going to be there likely within the next month or two in terms of being where the Fed needs us to be in terms of, what CPI is looking like. Look at PPI. Look at how much that's come down. So when you look at these different factors, he's given an opinion out there, but I'm just like, factually, it's not up for debate. Factually, things are moving exactly in the way you want to move when it comes to inflation. The commodities index, GSG, is up 1% this year. 1%? We will take that gladly. It's down 15% in the past year.
Et cetera, to get there. But the point is that when you have full employment, inflation is going to stay sticky, especially with asset prices where they are right now.
Did you think that the market or that the economy, I should say, would be weaker by this point than it is?
Yes.
You did?
Absolutely.
Did you think that the labor market would be weaker by this point than it is?
Absolutely.
So what are we missing?
Sure.
What are we missing?
Here's the big thing. We have a $2 trillion budget deficit. That is a $2 trillion annual stimulus package that we have that is more or is equally offsetting the monetary policy that we've had in place. I've been shocked that Powell hasn't talked about this more, but that's a massive offset. It's looking like the deficit's going to be $2 trillion this year.
He going to talk about his bosses like that? Come on, man.
Right? If you pay $1 in taxes, the private economy gets $1.50 back. That is a 50 cents that's going to the private sector, and that's exactly what's happening. The second thing that is the liquidity flows, right? We all know the Fed is in QT, okay? However, the Bank of Japan, right, 6 months ago was growing their balance sheet. And so the liquidity flows have actually increased by $1 trillion since the October lows in the market. So those have been tailwinds for the economy and for multiples that have been there. Now, we think the liquidity flows are going to inflect.
Yeah, so overall, he brought out some good points in that video. I think he was a little bit desperate for some of those points. And, you know, when you kind of put on the spot like that and you've been obviously massively wrong about this whole, you know, it's going to be devastation, this and that, you're in a tough pickle for a gentleman like that, obviously. So some of his points were definitely just, let's call it reaching a lot, okay? Next one up here, the Fed might cut rates this year if U.S. Gets weak employment data.
Of SMBC, Nikko Securities America. He was formerly the chief economist for the National Economic Council. Joe, always great to see you.
Thank you.
If the Fed's inflation target really is 2% and remains 2%, does that mean that we have to have a recession?
No, I mean, listening to when Karen asked Steve about, you know, would they cut with inflation still above 2? My answer is yes. It depends really on the unemployment rate. And in the Fed's forecast, which showed 2% core inflation in 25, they've got their unemployment rate well above 4%. They lowered it from where it had been, but it's still well above 4. I think it peaks at like 4.3 or 4.5, somewhere around there. That would be consistent with recession. So I would argue if the labor market weakens in the next few months and we see that rate move up above 4, we'll have a recession, because we know historically, going back to data to Second World War, when the unemployment rate rises 50 basis points from its low, we've always had a downturn. And my guess is when that happens, when the Fed actually sees it, they will pivot, meaning they will focus on the unemployment rate, which is a leading indicator of inflation, and they won't worry about where the inflation rate is at that point in time.
Yeah, so if you know my perspective on this, my perspective has been if CPI keeps coming in target, and next thing you know, let's say in the next few months we're at 2s as far as CPI, which we should be, then as soon as you get any sort of worrying economic data, the Fed's going to be quick to basically cut rates. And the reason being is obviously they don't want to have to deal with an economy that plummets or something like that. Because then all of a sudden, guess what has to happen? Then they have to come save the day. You have a bunch of banks go under. You have to save the economy. There's going to be ridiculous amounts of spending, which is going to cause deficits to get worse than ever. You have to go through all that, okay? So they obviously don't want that. Now, the hidden reason why the Fed really is, ultimately the Fed's going to want to cut faster. And the real reason is, and this is not talked about enough out there, the real reason is for every little quarter point, the Fed funds rate is higher. The government has to pay so much more interest on the debt, okay? And so in this sort of scenario, in my opinion, like the government, which, the Fed's supposed to be separated from the U.S. government, but at the end of the day, these folks work together. They're all part of the same team, okay? You could say this is separate. They're all part of the same team, okay? So ultimately, it does not favor the U.S. government to have high rates for any sort of long period of time. They could do it in the short term to try to kill that inflation, which is exactly what they've done. But over the period of several years, you don't want that. Why would you want to pay all that extra interest? Plus, why would you want to have let's call it we could call it a brake pedal on the economy, right? So unless you're having to deal with super high inflation, which is what we've had to deal with. But as soon as you're out of that scenario, you're like, let's try to get this down a little bit. So they'll use anything that they want to use as, something's weakening, employment rates weakening, whatever, we're ready to cut.
So it sounds like you think there will be a recession, but then in response to a recession, the Fed will quickly pivot. So that brings into the picture a rate cut, if pivot means cut, this year.
Yes. Yes. I remember in 2007, we at the time thought the economy was very weak. There was excess housing leverage, excess allocation of capital to housing. And the Fed wound up pivoting very quickly, basically within 3 days. In August of 2007, they wound up cutting 100 basis points for the year. So if the labor market breaks, and we'll get some data tomorrow, Melissa, that cover claims for the survey week, and they've been edging up, very gradual, but edging up. If we get some weak employment data in the next few months, and we're due for it, we've had, I think, 14 consecutive months where the street has underestimated payrolls. It's a record long in terms of length. Then I think things can happen very quickly, and you actually could see the Fed cut this year. So I would not rule that rate cut out. Absolutely not.
Joe, it's Karen. Let me ask something. You talked about a 50 basis point increase in the unemployment rate triggering a recession, but has it ever been a 50 basis point increase with a base?
By the way, if anybody's confused about 50 basis points, that basically just means 0.5%. So think of it this way: if we're at 3.7% unemployment right now, let's say for instance, he believes it's going to go to 4.2 if you're talking about 50 basis points.
With a unemployment rate as low as it is now.
Yes, we've had the unemployment rate actually a couple of times below where it is now. We've had it one time around 2.5% in the 50s and one up well over 6. So yes, it doesn't really matter where it's starting. Where it goes, where it rises, is going to be partly a function, Karen, of how deep the recession is. And the reality is, whenever the next recession happens, we really have no idea if it's going to be deep or shallow. This notion it's going to be shallow, I'm not sure what it's predicated on. We thought when the economy, I say we collectively, when the recession hit in 08, it was going to be shallow. In fact, the economy even grew almost 2.5% in the second quarter of 08. Whether it's shallow or not will depend in part on what the Fed reaction function is to the economy at that time. And my guess is with the election next year and fiscal policy as messy as it is right now, you're going to get no fiscal relief. So when it comes, it could be a deep recession.
Joe, you're unlike many economists, and you're cool because you like Van Halen. But most economists aren't able to predict.
That does make him cool, I will say. Van Halen, man. Great. Love Van Halen.
Even get out there and predict where the economy's going. Why I connected these two, I just wanted to point out that I met you at a Van Halen concert once, serendipitously.
I do love Van Halen. I would say I wouldn't like. I'd say I love.
You love Van Halen. I don't love that economists never seem to be willing to get out there and anticipate where the economy is going. And I don't mean you, and maybe I'm really talking about the Fed. If we all know that labor is going to slow, we all know the economy is slowing, why can't the Fed say, I think the economy is going to be here in 6 months, so I'll take policy there right now? Why are we so data dependent? Why are we waiting on a lag we all know is there?
The answer is, Tim, it's political, I think. And I think one of the reasons that Chair Powell, I think he made a commitment to the president to get inflation down. And again, it's a forecast that the rate now, it's up 3.4 to 3.7. History would say if it goes to 4.0, you're going to have a recession. You'd be in recession. So I think it's that commitment to get inflation down and the uncertainty that it's a forecast. It doesn't, it's a forecast means it may not happen. And to me, that's why Jay Powell has done what he's done. And they really want to see more evidence that they need to be where they want to be. But Tim, this is also the litany or the history of the Fed. The Fed always overdoes it. And this would be yet another example of the Fed overdoing it, because when it happens in real time, for whatever reason, they forget about the lags and the politics may be such they have to keep pushing. And it's a mistake.
Yeah, good point, man. And I'm 100% in agreement with him. And they are always overdoing it on both sides of it. And we obviously saw them go way too far, obviously, at the end of 2020 into 2021 and continue to pump. And it was just like, dude, lay back. And obviously that's just one of many reasons why we had to deal with insane inflation, right? But overall, I mean, like I said, when it comes to this recession story, it's going to keep getting pushed out. If we don't get it in the back half of this year, it's going to get pushed out to early 2024. Then if it doesn't happen in early 2024, they're going to push it out to, late 2024. I'm almost like, let's just freaking have it. So then we can at least have it, and then, it can be there, and we can talk about it, and and then it's seen as we're coming out of that situation, right? But man, it has been just a drag on. And I don't know when it ends, in terms of that talk. But when it does end, that's when you short the living crap out of this market by puts on flip and flapjack and everything, when no one is talking about it anymore. I appreciate everybody joining me as always. Thanks so much, folks. It's always good stuff. But anyways, pin comment down there. Make sure you get access to that. Enter in your email. We'll send over the deal as soon as it drops on July 4th when we open that tier for July 4th. Okay. Appreciate everybody much. And by the way, if you don't know what that's for, that's to see all the moves I'm making in the Patreon portfolio each and every week, which, it's I think it's pretty good education for $10 to be able to see the moves I'm making in the market, see how I run a portfolio with my hedges in there and everything. It's a no-brainer. So make sure you access that. It's pinned comment down there. Much love and have a great day.